Hi, and welcome to Dollars and Cents with TBK Bank. I'm Andreya Gordillo, and I am a market sales manager. With TBK Bank, I get the opportunity to work in the communities we serve to provide complimentary financial literacy presentations. Thanks for watching this video. Today's topic is You Can Bank on It, and we will talk about banking services and how you can build a positive banking relationship with a financial institution. By the end of this video, we will have covered the different financial products and services available to you, information on selecting which products best fit your needs, and a few basic steps for managing a checking account. To begin, let's first talk about the different banking products that are available. Banks are financial institutions with a variety of products and services available to help you manage your money. These services include checking accounts, savings accounts, credit cards, loans, mortgages, and certificate of deposits, which are also referred to as CDs. Let's talk about some of these accounts in a little bit more detail. You can deposit money into a checking account, a savings account, and into a CD. A checking account is best used for your everyday spending. You use money in this account by swiping your debit card and by writing checks. Money is meant to move in and out of this account frequently. A savings account is different from my checking account because the money that you put into your savings account is not meant to move in and out often. A savings account is where you put your money when you want it to stay there for a little while. Another difference is that a savings account will sometimes pay you interest. You can access the funds in your savings account at any time. But sometimes a bank will set a limit to how many times you can take money out of your account each month. A certificate of deposit, or also known as a CD, is more like a savings account in that you put money in there and you let it stay there for a longer amount of time. A CD is different from a savings account though, because when you open a CD, you agree to leave the money in there for a predetermined amount of time, typically being 6, 12, or 24 months. You will earn a higher interest rate on the funds that you leave in your CD, but you will be charged a fee by the bank if you try to take the funds out before your predetermined date. Those are the types of accounts where you can deposit money. Now, what about if you want to borrow money from a bank? A few options for borrowing money include credit cards, loans, and mortgages. Let's briefly discuss each one in a little bit more detail. You can open a credit card with a bank to use in a variety of ways. Everyone uses their credit card differently. You swipe the card when you're checking out, similar to a debit card, but the money does not immediately come out of your checking account at the bank. Instead, all of the charges are compiled in a monthly statement, and you are responsible for paying that money back at the end of your billing cycle. Any money that is carried over from one month to the next will require you to pay interest on, and interest on credit cards can be very high. So it is very important for you to pay off your balance in full each month if you're able to do so. A loan is a product that allows you to borrow a specific amount of money for a specific amount of time to buy something like a car or make repairs to your home. You will be charged interest on the loan, and the interest rate is dependent on your credit score and the size and duration of the loan amount itself. A mortgage is a loan as well, except the money is used specifically to purchase a home. It's typical that you will get a 15 or a 30-year mortgage, meaning you will pay the balance back within 15 or 30 years. You are also charged interest on the mortgage, which is dependent on your credit score, the size, and the length of the loan. Those are the 3 examples of loan products that a bank will be able to offer to you. So which choice is right for you? A checking account or a savings account? A loan or a credit card? It all depends on what your needs are. Stop by one of our bank branches anytime to ask one of our bankers about which products best meet your needs. But don't be afraid to shop around to find out what works best for you. Once you have done your research and decided which banking products are best for you, you want to make sure that you manage your accounts well. Following the rules and restrictions on your account will help you save money, keep your costs down, and it will help you develop a positive banking relationship. Right now, I want to specifically talk about managing your checking account. Like I talked about earlier, checking accounts are used for your everyday purchases, such as paying for bills or buying groceries. You can also withdraw from your checking account using an ATM. There are a few unique features associated with checking accounts that can help you manage your money. The first feature is the ability to direct deposit. This means that money can be safely and securely deposited into your account electronically. Instead of your employer having to write you a physical check and you having to make a trip to the bank to get it deposited, with direct deposit, the money will show up in your account automatically on payday. Another feature available with most checking accounts is automatic bill payments. This allows you to schedule and send payments electronically. These payments can be set up as a one-time payment or on a reoccurring basis to make certain that your bills are paid on time and in full each month. Something to be very aware of with your checking account is what's called an overdraft. An overdraft occurs when you swipe your card or when you write a check for a purchase that you don't have enough money in your account to cover. If the transaction does go through, you will be responsible to pay back the money you spent in addition to a fee, which can be very expensive. Knowing how much money is in your account before you swipe your card or before you write a check will help you keep from overdrafting. Thankfully, most accounts come with online or mobile banking options, which allow you to check your balance often and even when you are on the go. It's also important that you keep track of the checks that you write. When you write a check, the money doesn't automatically come out of your account. It first has to be deposited by the person that you made the check payable to, and even then, it can take a few days for the money to come out of your checking account. If you write a check and forget about it, you might be surprised in a few days when the amount comes out of your account when you weren't expecting it. It is very important for you to understand how your account works and what fees are associated with the account as well. You also need to keep a very close watch on your account balance to avoid overdrafting and having to spend your hard-earned money on overdraft fees and insufficient fund fees. Thank you for joining me on Dollars and Cents with TBK Bank. I hope you learned more about the products available to you and how important it is to manage your accounts well. If you're interested in learning more about TBK Bank's convenient products and services, please contact your local branch or connect with us on tbkbank.com. Thank you for your time and attention.